Ladies and gentlemen, welcome back to the channel. Here in this video, I will explain why this market short squeeze could be nearing a short-term end. And I'll discuss that. And you may say, what are you talking about? A short squeeze and capitulation this, capitulation that. In fact, yes, the last week or so of trading, the last 7-ish days of trading, you have seen a short squeeze. You have seen a lot of capitulation to the upside. A lot of investors that were sitting on the sidelines that were shorting our markets either are getting squeezed out of positions or saying, to hell with this cash, we got to get in markets because stocks can never go down, valuations don't matter, and there's a soft landing. Why would we not be in equities? In fact, unfortunately, that's not how things work. And we could be nearing the end of just that. Now, I do want to play this clip from Tom Lee. He was on CNBC today. He tends to be someone that is very, very, very bullish. Now, he's still very bullish, but he's saying maybe he was wrong in not being even more bullish, which sounds like even upside capitulation from Tom Lee's perspective. See, keep in mind, Tom Lee was expecting some kind of election correction. I was not. I was never in the camp that stocks need to fall before the election or need to rally afterwards. Tom Lee's saying maybe he underestimated the strength of this market, which to me sounds like the last bear turning positive, which that tends to be like the worst time to invest. Now, Tom Lee was not a bear. He's obviously a bull, but he was short-term negative and now he's turning positive, which kind of feels like that same effect. Now, at the same time, all of this is happening. You do see U.S. high yield credit spreads that have moved down to 2.89%, their tightest levels since June of 2007. Basically, the markets are not pricing in any risk whatsoever. No risk via the economy, no risk for anything, essentially.
Let's get to the markets. Following last week's inflation data, Tom Lee's here, managing partner and head of research at Fundstrat Global Advisors, as well as a CNBC contributor. Tom, in recent appearances, I would say that your conviction hasn't necessarily been quite as strong as it had been in some of your other calls, where there's been a time where you said the inflation data will be so good that the S&P will be up 200 points in the next week, and it panned out, and it played right into what you were saying. The last time you were on, I think your basic thesis was that market's still solid through the end of the year, but in the meantime, there could be some volatility and maybe even a pullback. Now I think you're saying it's been more stable than what you're expecting, and it has to do with liquidity and cash on the sidelines more than anything else.
Yes, that's right. You're right. We've kind of been sort of, I think, fooled by seasonality because we thought markets would be hesitant before, the elections, and it's October, but we've seen this market be incredibly resilient. So I've underestimated how strong this market's been. I think it really shows macro data is becoming less important, and it's now the fact that a lot of cash has been on the sidelines. For the last 2 years, investors expected a recession, or many thought when the curve uninverts, we got a recession. But at the end of the day, there's $6 trillion of cash on the sidelines, and October has turned out to be a great month.
We've seen it, evidence of what you're saying, and I know how closely you watch it. We've seen it on a daily basis over the last, I'd say, maybe month or so, where many days we're even down triple digits in the futures, only to end up 250 or 300 points by the end of the session. And with no backdrop of positive news, nothing to account for it, other than it seems like there's money on the sidelines that's coming in.
I mean, it feels like investors are underinvested in stocks. I think there's people who've dreaded 2024, thinking this is the year we slip into a recession, and instead, and we're seeing it with earnings, companies have been really resilient.
Yeah, we waited to retest the lows a couple of times in 2022 and 2023, and people weren't bullish at all. We didn't get great advances, and now it's almost unstoppable. And nothing seems to be able to knock it off a track, whether it's, I think the PPI and CPI were both a little hotter than people thought. The prospects for a Fed continued easing cycle are now open to some conjecture, I think, although most people say it's still going to happen, even though things are pretty solid in both the economy and the stock market.
Yeah, I mean, I think it makes sense for the Fed to be dovish just because inflation is still tracking, especially PCE, towards their 2% target. And now we have some concerns about the job market. So I think the Fed has to be supportive. And I think this election, which is becoming less of a coin toss, I think because it's been a coin toss, people have been sitting on their hands. I think these are reasons markets are starting to have conviction even in front of an election event.
I think we've soft pedaled it too. The swing states have even some of the swing states that looked like solidly in Harris's camp are now truly swing states where Trump's up in Michigan and Wisconsin, and that betting and everything else. And if NBC goes from Trump up or from Harris up 5 to Trump and Harris tied, and then you do a full field and Trump is actually up in a full field thing. So I think you might be right. Bitcoin's at 65,000. You wouldn't say that the stock market's performing better because it's starting to look like it's less of a coin toss, would you?
I think markets like visibility. So if it looks like one candidate is now looking like to be the surprise winner, then markets can actually trade better before the election.
Wait, does it matter? You said markets like visibility. They have to like what they see on the other side of it, I would assume.
Yes. I mean, I'm probably just citing market history, but whether Trump or Harris wins, I think stocks do pretty well next year, sort of a post-election rally. But there are definitely differences in sectors and asset classes performance depending if Trump or Harris wins. But Bitcoin, for instance, is something to watch if Trump looks like he's strengthening because Trump is running on a pro-Bitcoin platform.
All right. Now, you said something, we'll get off of that, the politics. You said that you agreed with almost the asymmetric risk now. And I still think it could go the other way. I mean, I think the labor market looks pretty solid given that last report, and that we're still, if PCE is 3%, it's got to go down another 33% to hit 2. And they swore they're not moving the goalposts. It's 2. It's 2. It's 2. It's not 2.5, Tom. It's 2.
Yes.
And what makes you think that that's in the car? Who knows with the Middle East and everything else? But oil's back to mid 70s and could go higher.
Yes.
I'm more worried about it. I don't know. They're more worried about the jobs picture than stubborn inflation.
Yeah, I mean, you're actually right. Oil spikes can cause an inflation spike, and that would be a surprise. But if we look at what's been keeping inflation stubbornly high, it's been shelter, which in the latest inflation report finally is rolling over, and it's auto insurance, which is now just beginning to sunset. So in the second half, auto insurance becomes a tailwind. And then the question would be, are core goods going to stay under pressure to kind of bring overall inflation down? And it looks like core inflation, on goods, looks like it's going to remain soft. So I think inflation doesn't have the upside drivers except for what you're saying, a commodity shock.
Which I can make a pretty sound argument to say the Fed, when they start tightening cycles, typically causes recessions about 80-85% of the time. Okay, fine. That's one thing. Maybe this time is different after all. But is it logical to say there's a 0% chance of a recession when the statistical probability is 80-85% during tightening cycles and subsequent cutting cycles? No, that doesn't make a whole lot of sense whatsoever. And in fact, I'm actually reading this book right now called Secrets Every Investor Should Know You Weren't Supposed to See That by Josh Brown. We play his clips sometimes from like CNBC. Very, very good read so far. But one thing that really stands out from this book, to kind of put it in simpler terms, when the Fed was raising rates, talking about pain to the economy, what they were really trying to do with raising rates is to slow down the wage inflation, to slow down inflation. Okay, we get this, but specifically wage inflation, and to slow down labor markets. That was their goal. It was always the labor markets. They're too tight, right? We want to slow that down. And that's what was signaled via the size of their cuts, going from, 50 basis points to 3 back-to-back 75 basis point cuts, and then ultimately to a couple more cuts, and then waiting and pausing. What this book really highlights is it's just a translation between we need to slow down the labor market. So a 50 basis point cut for the first cut signifies there is already a lot of pain in the labor market, and the Fed messed up. And the simple basic principle of that means that maybe there could be more pain to come. That maybe last month's jobs report was just a one-off. That maybe things are not going to be smooth sailing for, a period in time in which the markets are pricing in a smooth sailing, a picture perfect scenario. And we know that's probably not going to happen. So as you are seeing this upside capitulation as stocks continue higher for no reason, let's acknowledge there is zero, zilch, zip, zada reason why stocks are moving higher as of the last week or so. Besides, again, a short squeeze and an upside capitulation. Because again, as I shared in the last video, here's why companies will beat Q3 earnings estimates. Because Q3 earnings estimates have plummeted. Okay? Plummeted. Just on a crazy scale. Q4 earnings are also plummeting, and 2025 earnings estimates have been plummeting ever since September. Typically, when earnings estimates fall, especially for the next year like 2025, that tends to lead markets lower. When earnings estimates rise for the following year, that tends to lead stocks higher. And that's what you've seen, and that's what really drove 2024. Earnings estimates for 2025 around mid-February bottomed and started to rise. And they really continued to rise until they plateaued around July, which was the prior all-time high. And then what happened? You've seen a little bit of a boost in early September. And then by late September, you started plummeting on earnings estimates. Stocks, in theory, should be following suit. You should be moving lower right now, not higher. And for the first time in 22 years, bonds are yielding more than stocks. This has not happened since the early 2000s for a brief period in time following the dot-com bubble. This is actually showing you the 10-year treasury yield versus the S&P 500 earnings yield. Now, bond yields are earning more than S&P companies are earning. Now, Fundstrat earlier today posted this. Of the 31 companies that have reported so far, 6% of the S&P 500. Overall, 74% are beating estimates, and those that beat are beating by a median of 6%. That's not good, okay? That's not good because the earnings estimates have plummeted, okay? Very easy to beat earnings when your estimates have plummeted, okay? Of the 23% missing, those are missing by a median of negative 10%. Ouch. That's bad. Even after estimates have already come down, that means they would have missed by like a median of 15% or so if the estimates were still unchanged. That's not good at all. On the top line, overall results are beating estimates by a median of 2%. So you're not really beating if you factor in the fact that earnings estimates have plummeted. You'd actually be missing estimates on the top line by the average company and missing by a median of negative 2%. And 58% of those reporting are beating estimates. So it would really be like way lower than that. Way lower than that if the estimates were still where they were just 3 weeks ago. Now, as Tom Lee said in that clip, he was initially expecting some kind of correction or volatility before the election. He says, now we don't need to see that. I was never in the camp of we need to see an election correction. We have Q3 earnings estimates that are falling like that. That's bigger than the election, in my personal opinion, as far as a downside catalyst. Geopolitical tensions, you have the economy that looks like on paper it's doing better than it actually is. We'll see if that gets reflected in the data. Could be after the election. We'll talk about that in just a moment. But you have all these other things going on. The election is like the last of our concerns as far as what's going to affect markets. So no, you never had to see a seasonal election correction. That means you don't have to see a huge rally after the election either. And I don't think we're going to get that. I think you could actually see the opposite. I think it's very well possible you see a rally into the election, And then after the election, things start to get a lot more dicey. And why that is because I've always, since August at least, been under the impression that the economy is going to hold up at least until the election. That what I'm seeing and hearing in the active real world economy is much worse than the data is representing. So after the election, that's when the data may start to turn decisively more negative. And that's when the pain for stocks could start. So I'm actually concerned for the second half of November through like March of 2025. That's when I think you're going to see the larger downside price action for equities. And it's easy to make this call. I mean, this is not a genius, 200 IQ call when stocks are pricing in perfection and we are far from perfection. Like the economy is not perfect. The labor market is not perfect. The company earnings situation is not perfect. Markets are pricing in perfect. So what does that mean? Put 1 and 1 together, it equals 2. It means stocks are probably mispriced. I mean, I don't think it's any secret that Warren Buffett has the most amount of cash in the firm's history of Berkshire Hathaway. And again, that's why I think you're seeing a short squeeze and upside capitulation right now, because the last of the bears are starting to capitulate. When you see these kind of upside capitulations, when you see these blow off top rallies, as some people will call them, it tends to be the end. Tends to be the end of at least a intermediate cycle and the start of something a little bit more corrective in nature. And I think that's exactly where we are right now. It's going to be very hard to call the top, if you will, and that's not what I'm trying to do. This could be the top, could be, or we could continue to rally for a couple more weeks. But what I do know is you're getting close to that top. Unless the economic data just comes in really good, unless the labor market is super, super strong, then at that point, you're going to see what you've seen today. You're going to continue to see NVIDIA lead, Apple lead, Meta lead, Google lead, Microsoft lead, and Amazon lead. It's going to be a Mag 7 market, and that's it. You're going to go back to the same playbook as the last 18 months. Now, if you do see things weaken a bit from here, but not quite recessionary, you're going to get a broadening out of our markets. And there's going to be much more participation. Now, to a certain extent, you start to tip the scales and things start to get even worse and markets in general start to sell off. And I don't know if that's the direction we're going to go in. But if you see big tech start to fall, you could see a broader market rally and the S&P still fall. Again, I don't know exactly which way this is going to play out, but even if you're a bear, you probably think the odds of a recession are like 20%. At least 15% is like a normal year. 20%, 25% would sound very reasonable to even a bull, right? And that'd be reasonable to a bull. Even though the historical precedence is 80-85% chance of a recession. Still, this time could be different. Markets are not priced for even a 2% chance of a recession. They're not priced for a 1% chance of a recession. They're priced for a 0% chance of a recession, as you can see in the high yield bond market. Now, I do think that means Tesla stock can go higher in the near term. I don't know exactly when markets are going to fall, but I do think you want to be conservative here. I think you want to be defensive and ready for a larger downside corrective price action in markets, which will set you up for a better buying opportunity in Tesla stock. So I don't know exactly when things are going to start falling. I don't know if it's going to be once you get into the heart of this earnings season. I just don't know the exact timing. I do know this blow off top rally, this short squeeze that we are currently seeing is not going to last. There's nothing that fundamentally justifies this. Again, earnings estimates are falling. So as markets rise, you're actually getting much more expensive. Like normally you want to see markets rise and earnings estimates rise, so stocks actually get cheaper over time, or at least maintain their current value, right? If for simple math's sake, if the S&P 500 did $100 of EPS, you give that a 20 times multiple, right? You're going to be sitting at $2,000 on the S&P. Now I know things are a little bit different on that. But if S&P 500 earnings go up 10% to $110, right, then your price is going to go up as well in lockstep with that. So the valuation would stay the same. If earnings estimates start to go down, then you get more expensive if the price goes up, right? Just to kind of try to keep this as simple as possible. So that's what's happening right now. You're getting more expensive because earnings estimates are falling and the multiple's getting more expensive. Now, we are going to get much more earnings this week, starting off even tomorrow morning. Walgreens, Boots Alliance, United Health Group, Citi. You also have Bank of America, Johnson & Johnson, Progressive, Charles Schwab, Goldman Sachs, PNC, and State Street, some of your big banks. Tomorrow and after hours, you have United Interactive Brokers, JB Hunt, SGH, Pinnacle, but some other smaller banks as well. Throughout later this week, you do have ASML, AI stock. Thursday, you have TSMC, AI stock. Netflix, Thursday and after hours. That one's going to be important. For big tech, you have American Express, which is one of the largest credit card companies in the world, and that's going to tell us a lot about the consumer. So, earnings estimates falling, it's going to be easier for companies to beat earnings, but is that going to be really impressive? Is that going to justify the markets? I don't think so. What I do know is markets are mispriced, and you're not going to keep up this momentum forever. You will see markets come down. And I do think this could be nearing the end of this blow off top short squeeze rally that we are currently experiencing. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys stay safe out there, and I will see you in the next one.